Happy Thursday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Thursday, November 10th, 2022. So huge day in markets this morning. Huge day to make me feel like an idiot. So we got the CPI report for the month of October, and quite frankly, we were just wrong. The core inflation measure came in below consensus. We thought it would be a very slight beat, at least according to our model. So our model was wrong on that. Having a bad week in terms of the portfolio construction, but guess what? Next play. So our job today is not to overreact to what we're seeing in markets, but rather assess the data to see if it provides us any clues or insights to see if we're in the beginning or the early stages of what could be a phase transition in the dominant market regime. Recall that we've been pricing in what we call inflation here at 42 Macro, which is growth down, inflation up on a trending basis for much of the year. And, as it relates to this current market activity, we want to be on the lookout for Goldilocks, which is the opposite of inflation, or a phase transition to deflation, which would coincide with a reversal in the absolute performance of bonds and duration-sensitive securities. So nothing definitive yet. We need to analyze the median CPI data and the trend mean CPI data from the Cleveland Fed as it trickles in this morning. We also need to analyze the various sticky CPI reports from the Atlanta Fed as they trickle in this morning as well. So we'll be back in terms of updating our subscribers with our incremental thoughts there. And when we get the data that really matters, in our opinion, the underlying core, the super core measures of inflation. But anyway, just getting into what has already been reported as of 8:30 this morning. So headline CPI slowed accelerated rather on a 3-month annualized basis, 180 basis points to 3.8%. That's the fastest rate we've seen since August of 22. That's moving in the wrong direction. What's causing that is a massive acceleration in energy inflation. We saw that accelerate 2,360 basis points to down 21.4% on a 3-month annualized basis. That is also the fastest rate we've seen since August of 22. We're now starting to finally see some reprieve on food inflation, rather. Food inflation decelerated 200 basis points to 8.8% on a 3-month annualized basis. That's the slowest print we've seen since January of this year. And then shifting to core. So core is where all the action is. And I've been saying that for several months now, really going back to June when Powell was talking about headline. We said in June, stop talking about headline. Don't pay attention to Powell. The discussion is going to be about core. And that's very much where we are today this morning. So looking at core, we see that core inflation decelerated 20 basis points quite modestly to 5.7% on a 3-month annualized rate of change basis. That's the slowest print we've seen since April. 5.7% is not going to cut it as it relates to the Fed's 2.5, let's call it, inflation target. But again, it's getting, it's moving in the right direction, but very modestly. What's driving that move in the right direction in a very material fashion is the sharp deceleration in core goods inflation. This is what investors have been expecting the entire time. We just haven't been getting it. So core goods CPI decelerated 240 basis points to 0.4% on a 3-month annualized basis. That's the slowest print we've seen since March of last year. On the other side of core, because it's not just goods, but services, which is actually a bigger component, we're seeing core services inflation accelerate. It accelerated 60 basis points to 7.6% on a 3-month annualized basis. That's the fastest we've seen since June. Driving that acceleration in core services was an acceleration in shelter CPI, plus 90 basis points to 8.8% on a 3-month annualized basis. That number is the fastest print we've seen since August of 1990. We heard from Chairman Powell. They don't care about how lagged OER is. They understand why it's lagged. They understand that there's still a ton of rental price increases still in the pipeline, and that is being reflected in the shelter CPI component. The most positive thing we've seen in this report, and it's not as positive on an absolute basis, it's just positive in rate of change terms, which is the services inflation, less rent of shelter, which I believe is one of the most important metrics to watch in the 830 component of the CPI release. That decelerated 90 basis points to 5.7% on a 3-month annualized basis. That number is the lowest we've seen since January. So that was a very positive move in terms of, kind of winterizing the noise associated with OER and associated with shelter, and just really looking at, okay, what is services inflation? The inflation that the Fed is most responsible for as it relates to the labor market. What is that doing? So that decelerated 90 basis points again to 5.7% on a 3-month annualized basis. Now, that's good in delta terms, but in absolute terms, we're well north of the 2%, 2.5%-ish Fed's inflation target, average inflation target. And more importantly, we're still 170 basis points north of the Fed funds rate in terms of this 3-month annualized metric. And that's an issue because when we look at the CME's Fed Watch tool, we've seen some pretty material movement in implied policy rates in terms of the projected path of the Fed funds rate. So just taking it here. So looking at the December meeting now, December is now of 81% probability of a 50 basis point rate hike to 4.5%. In February, we now have the modal outcome being a 51% chance of a 25 basis point rate hike in February to 4.75%. And then lastly, the terminal Fed funds rate expectation is now expected to be 5%, according to the 47% probability of getting to there in the Fed's March 22nd meeting. And if you go forward from there, you can see that the markets are no longer pricing in any hikes beyond that 5% level we're likely to reach in March. And so if you think about going back to that core services less rent of shelter inflation, we're at 5.7% now. The market is the Fed funds rate is at 4% now. And so the market is effectively saying, hey, by March of next year, in terms of the February data we're going to get from the February CPI report, that the Fed funds rate of 5% will be below that core services or that services less rent of shelter inflation measure, that 3-month annualized measure, because again, it's not about the year-over-year rate of change anymore. It's about the sequential momentum in the time series. That's going to be the Fed's clue as to where year-over-year inflation are likely to be, 3-6 months forward. And so I thought that was very helpful. But again, don't take anything definitive from this. Again, we still need to analyze those super core measures of inflation, trim mean CPI, median CPI, sticky CPI, to get more clues as it relates to what to do with all this information from a medium-term perspective in your portfolio. So 42 Macro subscribers, stay tuned for that. Anyway, getting into my Longbow dashboard, obviously a lot going on this morning. So just walking through global macro, US dollar, that's got bearish short-term price momentum, bullish medium-term price momentum in the middle of its range here. Dollar, as we've been talking about for the last few weeks, at least on the around the horn and behind our paywall, dollar's really starting to trade heavy. We've seen a pretty material shift in positioning associated with the euro. Historically, that's been quite positive for the euro, and we're now really starting to see the dollar get weighed down by some of these market activity. It's too early to make a definitive call on whether or not this is different. We need to see more data. We need to see more signals, but definitely calling that out because again, that's what's on the tape this morning in a major way. Gold, that's got bullish short-term price momentum, bearish medium-term price momentum in the middle of its range. 10-year Treasury bullish from both a short-term and medium-term perspective, from a price momentum perspective, in the middle of its range as well. Big move to lower in Treasury yields this morning. S&P neutral from a medium or short-term perspective, bearish from a medium-term perspective, in the middle of its range. VIX bearish on both durations, getting towards the upper boundary of its range. That upper boundary is where we are on the VIX at 27. But again, it's going to be down a lot this morning. So I'd actually be more concerned about the VIX declining, getting towards the lower boundary of its range. And in fact, if you think about it, a lot of investors who have been trapped in a lot of securities this year may use this as an opportunity or use any strength as an opportunity to sell. So be aware of that. There's a lot of behavioral dynamics in this market that we talked about in great detail with my friend Andy Constant over at Damn Spring in our Macro Bundle live show yesterday. He had a lot of really interesting thoughts around, how the buy side thinks about year-end as it relates to bonuses and what decisions they might have to make or be forced to make in terms of that whole process. So definitely go check that out if you're a subscriber and have access to that replay. NASDAQ 100 bearish on both durations in the middle of the range. Russell 2000 neutral on both durations, getting towards the low boundary range, but it's going to be up a lot this morning. Bitcoin neutral on the short-term duration, bearish on the medium duration. That's been oversold. Bitcoin's bouncing off those oversold lows here. So congrats if you bought the real bottom in Bitcoin. We made a mistake on Tuesday trying to buy Bitcoin a day too early, and unfortunately just got whipped around on there. But guess what? Even the pros get whipped around. I'm happy to be doing this every day. Good, right, rain, sleet, snow, hell, right, wrong, bad, or otherwise. We will be here every single day performing the same processes because, again, I think the community learned. When I make a mistake out loud, and we all learn from it. When other investors who do what I do for a living make a mistake, they tend to hide. They tend to tuck their tails in between their legs, and they tend to overtly focus on the things that are actually going well. I'm not doing that this morning. I'm having a freaking brutal day, and I'm in a freaking brutal week. And guess what? None of that's going to impact my rigor and intensity in analyzing the CPI data and trying to understand where to go here from here, because again, it's all about the next play. Anyway, keeping it moving here. Ethereum, neutral on both the short-term and medium-term price momentum. That is also oversold. It's going to be galloping this morning. Congrats if you bought the real bottom in that as well. Shanghai Composite, that's bullish from a short-term price momentum perspective, bearish on a medium-term perspective in the middle of this range, and then oil neutral on both durations in the middle of its range. Oil got really kind of weighed down in this crypto incident this morning. I think investors were thinking, hey, if crypto goes to zero, there's some percentage of global energy demand is going to go away. That's true, but again, the crypto is obviously not going to go to zero, so I don't expect that correlation to hold. And then lastly, my free daily alpha tab, where we have about 300 ETFs, all representing individual factor exposures across global macro. We sort it by odds to give you an indication what's most overbought versus most oversold. This is obviously a day where most people are going to want to chase. So I'll start with the chasing. You got Bitcoin, Ethereum, GBTC, all those things are oversold with neutral short-term price momentum. Healthcare, Simplify. Oh, my friend Mike Taylor, what's up? One of my mentors. So his healthcare ETF is probably going to be up a lot this morning. That's an oversold low. So you can probably chase that higher if you need to. Simplify Hedged Equity ETF. Energy, this getting bullish on both our short-term and medium-term momentum signals. Energy's oversold here, so this would be a fantastic spot to be allocating to energy. If you do not, if you share our view that energy demand is not going to go to zero as a function of what's happening with FTX and Binance. All right, cool. So again, a lot of investors are going to want to be chasing this morning, so that's why we started here. But I think it's equally as relevant to talk about the top side risks to this market, because again, there's a cohort of investors that are sort of trapped in some long exposures that they may want to tax loss sell into year end. And so you're going to see what I believe is going to be a pretty aggressive fight emerge between bulls and bears around this 3850 level in the S&P 500. So thinking about that, like what's most overbought? Materials. This is something we called out yesterday, I believe, bullish on both short-term and medium-term price momentum basis. Materials getting up there is probably going to be overbought this morning. So if you're long that kind of exposure, definitely be taking chips off the table to the extent you're getting quite the pop. So with that, Darius Dale presenting a very open, honest, and introspective macro minute this morning. Again, appreciate everyone for tuning in. Like I said yesterday, like I said in the macro scouting report on Tuesday, we do not get everything right. This is not some sort of charlatan, 3-card Monty program where we're always nailing it, and the stuff that we don't nail, we just hide and sweep under the rug. There is no rug here. There's no sweeping under the rug. There's only education and learning from our mistakes. And today, we just wanted to talk about that and highlight that, and appreciate you for tuning in. Catch you back here tomorrow. Cheers.